Accounting is the language of business. And if you understand just these 4 crucial accounting topics, you'll unlock amazing opportunities in your career. After earning my CPA over 10 years ago, working with dozens of fast-growing companies, and sharing finance and accounting tips that have reached millions, I'm going to share with you the topics you need to know and why they are so important. And it all starts with financial statements. I once worked with a client trying to raise capital from investors, but the information he provided kept falling short. He was getting pretty stressed because he didn't understand what financial statements were, and the investors were demanding them as part of the due diligence process. See, financial statements are like lab results of your business. They provide a detailed and precise snapshot of your company's financial health. Without them, you can't diagnose your company's financial position or track where it's been. But understanding how to read them is actually pretty easy. Here, let's start with an income statement. This is also known as a profit and loss statement, and it tells you about the profits or losses that your business is generating. So we start with your revenue, which is the money you are earning from selling your primary product or service. Next, we have your cost of goods sold, which are the costs directly related to selling your product or service. And without these costs, your business wouldn't exist. So I once worked with a client who sold software, also known as software as a service, or SaaS. Every time he sold a license to his platform, he recorded revenue. Then, the cost of hosting his website and the servers on which his code ran was recorded as a cost of goods sold, because without the hosting or servers, he couldn't deliver access to his SaaS tool. And if you take your revenue and subtract out your cost of goods sold, you get what's known as gross profit. And our siren is going off because we just got to our first profitability metric in the profit and loss. Gross profit is really important because it shows you how much is left over after each sale to either invest back into the business or pay yourself. And you need your gross profit to be positive. If you have a negative gross profit, you may not be in business for too long. Your gross margin is like your gross profit, but it's expressed as a percentage of your revenue instead of a dollar amount. So a 90% gross margin means that for every $1 in sales, you generate 90 cents in gross profit. And that's a great margin. But your business will have other expenses related to operating it. We call those operating expenses. So going back to our SaaS example, common operating expenses include office rent, legal fees, and payroll. But it's important to note that what may be an operating expense for one company can be considered a cost of goods sold for another. So I once worked with a recruiting firm where the payroll fees were actually considered a cost of goods sold. And this is because they relied on human talent to carry out their primary service, which was recruiting. Sorry, robots, the humans won this round. And once you account for operating expenses, our siren's going off again because we reach our next profitability metric on the profit and loss, net operating income. This represents your net operating income. Or put another way, this is what's left over from your revenue after you deliver your product or service and operate your business. But it doesn't stop there. There are also other income and other expense accounts. So remember when I said your revenue is the income generated from your primary business model? Well, other income comes from other sources. This can include things like cash back from credit card points or interest earned on a large deposit. And the same goes for other expenses. These are costs that don't relate directly to delivering your product or service or operating your business. So just like we have interest income, we could also have interest expense, and that would typically fall under other expenses. When you net these two, you get net other income, our third profitability metric. And that gets us to our granddaddy profitability metric, net income. Net income represents what's left over when you take all your income accounts and subtract out all of your expense accounts. And it can be shown before tax as well as after tax. It all depends on whether you are generating a profit or not. And now you know what an income statement is and how to read it. But knowing just about an income statement isn't enough. There's also the balance sheet, which to me tells you the most important information about a business. And I'll show you why in just a sec. But first, I was once working with a client and he was showing me his forecast and I asked, hey, where's your balance sheet? And he was like, balance sheet? And I was like, oh man, you are missing out on a ton of value here. A balance sheet shows you what your business is worth. It shows you how much you've generated in profits that haven't yet been paid out to the owners. It also shows you how much cash you have. So let me show you how to read one. first, it's separated by assets, liabilities, and owner's equity. This is actually a good segue to our second crucial accounting topic, the accounting equation, which states that assets equals liabilities plus owner's equity. And the whole field of accounting is pretty much represented in this one formula. And in understanding how to read a balance sheet, you can master this concept. So assets represent the items of economic value that the business owns or substantially controls. So when I spoke about a balance sheet showing you how much cash you have, well, cash is an asset, but assets can also represent other items like accounts receivable, which are amounts that customers owe you for sales that they haven't yet paid for, or inventory, which is the physical products or components that you plan on selling to customers, or fixed assets, which are assets that you plan on using for extended periods of time, like equipment or furniture. But that's just one side of the accounting equation, which can't exist without this other side, liabilities and owner's equity. Liabilities are amounts that you owe to the creditors of the business. And a common example is what is known as accounts payable. So remember when I said accounts receivable is an asset where customers owe you money for sales that you generated? Well, accounts payable, it's the exact opposite. This time, you did business with someone and you owe them money for something you bought but haven't yet paid for. And credit cards can be another liability, where this time you owe money to the credit card company. And how about a business loan? Well, would that be a liability? You betcha, since it's an amount that you need to repay to the bank. Oh, and how about amounts invested into the business by the owners in exchange for ownership of the business? Would that be a liability? Well, not quite. See, owner's equity is similar to liabilities in that it's something that you owe, only this time, instead of owing it to the creditors of the business, you owe it to the owners of the business. And we call that section owner's equity. And another really popular owner's equity account is retained earnings, which is the cumulative net income that the business has generated in the past, but hasn't yet paid out to the owners of the business. So this is a key takeaway in which the profit and loss and the balance sheet are connected. Net income from the profit and loss accumulates into retained earnings on the balance sheet. And that's one of the reasons a balance sheet is so valuable. You can tell just how much you're doing in earnings by analyzing your retained earnings balance over each period. So the accounting equation really just shows you how all the amounts that the business has in assets was funded by either amounts owed to creditors or owners of the business. And it gets represented in this financial statement that we call a balance sheet. And before we introduce the third final financial statement, let's do a quick recap on the profit and loss and the balance sheet. The profit and loss tells you about the performance of your business. It tells you where you are generating a profit or a loss. It's separated by revenue, cost of goods sold, operating expenses, other income, and other expenses. And you could analyze 4 levels of profitability, starting with gross profit, then net operating income, then net other income, and finally, net income. The balance sheet tells you about the position of your business, which is summarized by assets, liabilities, and owner's equity. Assets are items of economic value like cash and accounts receivable, while liabilities are amounts you owe to creditors like accounts payable and debt. Owner's equity is the amount that you owe to the owners of the business, like capital stock and retained earnings. The accounting equation states that assets must always equal liabilities plus owner's equity. And one important distinction between these two statements: the profit and loss shows the information on an incremental basis. So the profits that you generated here in Q2 2024, well, those are profits just for Q2 2024. The balance sheet is a little bit different. It actually shows the information on a cumulative basis. So the balances that you see here in Q2 2024, well, if those balances are the same balances as Q1 2024, that means that there was no additional balance sheet activity. So here is incremental and here is cumulative, which makes sense because your retained earnings is just an accumulation of your net income that hasn't been distributed to the owners in the form of a dividend. And we have one more financial statement to help you master financial statements, the statement of cash flow. And many would call this their favorite since it's all about your cash money. It provides you with the details between how your cash went up or down in a period. profits are not the same as cash flow. Think about it. If an investor puts $50,000 into your business, you wouldn't say you have $50,000 in profits. It's really just an investment. So your statement of cash flows would help you understand the answer to questions like, did I collect cash from new sales? Or did I delay any payments to vendors? Or did I take out a loan? And the statement is split between these three sections. Cash from operating activities, which is the cash related to operating your business, or cash from investing activities, which represents amounts that the business invested in items like long-term or fixed assets. Now, don't confuse this with amounts invested into the business, because that's part of our third and final section of the statement of cash flows, cash from financing activities. This represents anything related to financing the company. So maybe you took out a loan from the bank, or maybe you raised capital from investors, or maybe you repaid a loan. All of that would show up as a financing activity. And there are actually two ways to present a statement of cash flows: the direct method and the indirect method. The direct method shows your cash movements in plain English. So you'll see items like cash collected from customers, or cash paid to suppliers, or cash paid to employees. But while that's great for you to understand, it's really tough to put together. And you'll need all sorts of additional information from all the individual transactions of your business, which will be both time consuming and not always so easy to access. That's why many businesses present the statement of cash flows under the indirect method, which looks like this. Here, what we're in essence doing is presenting the net changes of all accounts on our balance sheet to back into how much our cash either increased or decreased. And what's amazing about this is that if you understand the accounting equation, all you need to do is grab your income statement and balance sheet to produce this. So I was once trying to collect financial statements from a client who hired me, and I only had their profit and loss and balance sheet. And I was waiting on the cash flow statement from them. And I was waiting and waiting. Finally, I was just like, forget this, I'll just build my own. And you can do the same with just some basic math. So let's revisit the accounting equation and think about the math on this. We said that assets equals liabilities plus owner's equity. That will always be true, absolutely zero exceptions. Well, that means that the net change in assets from one period to another has to also equal liabilities and owner's equity from one period to another. So however much assets grew from this period to this period has to equal the same amount as however much liabilities and owner's equity grew from this period to this period. Still with me? Because that means if I bring assets to the other side by flipping the sign, then the sum of all of this will equal zero. Here, let me show you how this works. So here I have a balance sheet, and I'm just gonna duplicate this tab. And we'll call this cash flows. Great. Now I'm gonna duplicate my window by hitting View, New Window, and let's just pull up the cash flows tab over here to the side, and I'll make this over here as such. Let's just get rid of grid lines. Okay, so I'm gonna first wipe all of these values over here. We're just gonna retain the structure of our balance sheet. But instead of showing the balance sheet values, I'm actually just gonna show the net change in the values. So I'll just take this period over here, subtract it out, the prior period as such. I'm just gonna drag this all the way down, and let's get rid of the totals as such. And now let's copy this to the left. Okay, so now if I set up a check to make sure that assets equals liabilities plus owner's equity, that should balance. So I'm gonna say the sum of all assets minus the sum of all my liabilities plus owner's equity. Check it out, it matches. And this makes sense, because again, all of my values on my balance sheet need to equal when it comes to assets equaling liabilities and owner's equity. So the net change in these accounts need to equal as well. Now check out what I'm gonna do here. I'm actually gonna flip the sign on all of my asset accounts. So instead of taking this quarter minus last quarter, I'm gonna do the opposite. So I'll just come in over here. Now this is referring to H8, which as you can see is Q3. So I'm gonna instead minus the value from Q4 as such. Okay, now I'll just copy this to all of these cells. Okay, now instead of taking assets equals liabilities plus owner's equity, I'm gonna actually take the sum of all of these values. And as you can see, it's zero. Now again, this makes sense. If the net change in assets equals the net change in liabilities plus owner's equity, well then if I make this a minus, the sum of everything here needs to now equal zero. So now here's the key. If I just come here and delete my cash row, you'll actually see my net cash movements. So my cash grew by 18,914. Now remember, the balance sheet is cumulative. So if I just take the cumulative value of this, let's go ahead and lock that to this over here, and I just drag that forward, you'll see my actual cash balance. This is the incremental cash movements, and this is my actual cash balance. Now, this is of course a much simplified version of what the statement of cash flows is, but it's this math that's fundamental to understanding the indirect method. So far with these first two crucial accounting topics, we haven't talked about a really important point, and that is what accounting method you are using with your financial statements. See, companies can either report on the cash basis of accounting or the accrual basis of accounting, and it's really easy to understand the difference between the two. The cash basis of accounting means that you treat all cash received from customers as income, regardless of when you delivered your product or service to those customers. But the accrual basis of accounting means you'll recognize that income only once you actually deliver your product or service, regardless of when your cash is collected. And the same holds true for expenses. Cash basis of accounting will treat any cash that leaves your bank account as an expense, with some slight exceptions. The accrual basis, on the other hand, will only consider something as an expense once you actually consume that expense, regardless of when the cash is paid. So the accrual basis cares a lot more about the activity of your business, while the cash basis really only cares about the timing of when the cash enters or leaves your bank account. So let's go through a classic example. Going back to our example of a SaaS company selling a license to their platform. Let's say you just sold a 12-month license for $120 and the customer paid you immediately. What's your income this month under the cash basis of accounting, and what's your income this month under the accrual basis of accounting? Go ahead and pause this video if you want to think about it. Okay, so for the cash basis, this is really simple. You got paid $120, so your income is going to be $120 this month. The accrual basis says, whoa, not so fast. See, you haven't held your end of the bargain yet with this sale. The customer paid you $120, but you haven't delivered your 12 months worth of services or access to this SaaS tool to your customer. So you'll have a deferred revenue balance, which is a liability, since it's something that you owe to a non-owner. So each month, you'll take 1/12 of your initial balance and move it from your deferred revenue balance on your balance sheet and classify it as revenue on your income statement. So let's now do the same exercise, but this time for an expense. Let's say you purchase tickets to a conference that's taking place in 3 months from now for $300. How much are you recording in expenses this month under the cash basis of accounting, and how much are you recording in expenses this month under the accrual basis of accounting? Well, with the cash basis, once again, it's really simple. You paid $300 for something, so you record $300 in expenses, even though you haven't actually gone to the conference yet. But under the accrual basis of accounting, you won't record any expenses just yet, not until you actually go to the conference. So until you go to the conference, you'll record it as an asset called prepaid expenses. Those are expenses that you prepaid but have yet to actually consume. Then when you go to that conference in 3 months, you'll take that amount that you initially recorded on your balance sheet as a prepaid expense and you'll throw it onto your income statement as an expense. So you may be wondering, well, which one should I use for my business? Well, a client once asked me the same thing, and they had some pretty complex payment schedules between when they purchased items and when they got paid from their customers. So I asked them, do you plan on raising any outside capital? And how big do you plan on growing this business? See, larger businesses, especially ones with outside capital, almost always opt for the accrual basis of accounting. That's because investors want to know what's actually happening in the business instead of how much cash is entering or leaving the bank, which they can still see by just taking a look at the statement of cash flows. Public companies, they actually need to record under the accrual basis because that conforms with what's known as generally accepted accounting principles. But the cash method is totally fine to report if you're a small business because it's so much simpler to manage. You don't need to book any complex journal entries or deal with scary words like amortization. And speaking of journal entries, you're probably wondering what those are. So let's now get to our fourth and final crucial accounting topic, debits and credits. And this ties to our third topic. It's all connected. See, in accounting, we follow what's called double entry accounting. That means that every financial event that takes place affects at least two areas of a business's financial statements. So go ahead, name an example of a financial event. So how about you purchased this magnifying glass for $5? I don't know, you were bored and somehow thought this would help your business. Well, now you have a $5 expense, and that leaves you with $5 less in cash, which is an asset. Expenses are affected by going up by $5, and assets are affected by going down by $5. But double entry accounting doesn't mean that one side has to go up and another side has to go down. Let's look at this example. Let's say you take out a $50,000 loan. Well, a loan is a liability because you have to pay it back. But now you also have $50,000, which is an asset. So here, assets go up by $50,000, liabilities go up by $50,000. So debits and credits help you understand how to record the two sides of a financial transaction using double entry accounting. But they don't really mean anything. A debit could represent either an increase or a decrease, and the same is for a credit. It all depends on what type of account you're talking about, and you must always record a credit for the same amount that you record a debit. No exceptions. So now you're probably thinking, well, how do I know which side of the transaction gets debited and which side gets credited? Okay. Before I explain this, just memorize this right here. Assets go up with a debit and down with a credit. Did you catch that? Once again, assets go up with a debit and down with a credit. If you know that, you'll know that liabilities and owner's equity operate via the complete opposite set of rules. Those go up with credits and down with debits. And that makes sense because they are on the opposite side of the accounting equation. So when we were talking about taking out a loan, well, assets go up by $50,000 and liabilities go up by $50,000. So how do assets go up? With a debit or a credit? Well, like we said, assets go up with a debit. And how do liabilities go up? Well, like we said, it's the opposite. It goes up with a credit. So the journal entry becomes debit cash for $50,000 and credit loans payable for $50,000 as well. But you may be thinking, well, what happens if I make a sale or if I have an expense? How does the profit and loss get affected by debits and credits? Well, remember, the balance sheet and the income statement connect together, and that's via net income on the profit and loss and retained earnings on the owner's equity section of the balance sheet. So anytime I'm generating profits, well, my owner's equity balance is going to go up. And anytime I'm recording expenses, my owner's equity balance is going to go down. So you just use the same rules with the journal entries as you would for owner's equity. Remember, since assets go up with a debit and down with a credit, that means that owner's equity, which is on the other side of the accounting equation, behaves in the opposite manner. Owner's equity goes up with a credit and goes down with a debit. So anytime you're generating revenue, your owner's equity balance goes up, which means you'll credit revenue, which credits your owner's equity to go up. And the more you generate in expenses, the lower your owner's equity balance becomes. So expenses will go up with a debit, which brings your owner's equity balance down. So if you sell your product for $120 and the customer pays you with cash, what's the journal entry? Debit cash for $120, credit revenue for $120. If you pay $1,000 in office rent, what's the journal entry? Remember, expenses make owner's equity go down. Owner's equity goes up with a credit and down with a debit. So you debit office rent expense and you credit your cash, both for $1,000. Way to go! You now know these 4 accounting fundamentals, but now you have just a basic understanding of financial statements. There's a lot more to be said about how they're connected, and this video right here, it'll walk you through all of those connections, and I'll catch you there.